Hello, mortgage fans. I hope everyone's enjoying the sunshine and life slowly ebbing back to normal, starting to feel a bit better again. In this week's update, what I've decided to do is focus really around affordability, which is primarily how mortgages are granted. Nationwide last week made quite a bit of press as they've upped the amount they'll lend to first-time buyers. So for the first time ever, they're offering people 5.5 times their income. So it's quite a big departure for a relatively conservative lender. That's part of a sort of bigger trend we've seen over the last few weeks and months, and certainly sort of post the first lockdown, where banks had become very conservative, but we're sort of slowly getting back to normal. And some banks probably getting back to what I'd say certainly sort of pre-pandemic approach around the affordability side. So what I've done is sort of pick out sort of the top end of what you can do if you're looking at buying a property for yourself, if you're employed or self-employed, or if you're looking at as a rental property. So just trying to put some numbers and some figures around that. So the first thing then is to think about sort of what mortgage affordability is. As I said at the outset, it's really how loans are granted. There was a big change a few years back, which I won't bore you with, and that was sort of post-credit crunch, and to look at how mortgages were granted to make sure they're actually affordable to the people they're given. So hence affordability. The upshot of this is that banks ignore the interest rate that you pay. They apply a stress test in the background to say, well, could you afford this in the future? Should your income decrease? Should interest rates increase? Is it affordable? And actually, it's a really, really good approach. And also specifically for our clients, we're sort of London-based and we do deal with more affluent clients, and it really does favour the higher earners because at the end of the day, a loaf of bread's a loaf of bread. If you're earning a lot of money, you have more disposable income, and that's what these models sort of play out. So it works really quite well. So without sort of being over sort of bullish on this, but I just wanted to sort of just show how it sort of works currently because it's pretty generous to the right people. So a couple of touch points then. I've done some numbers which I'll just sort of play through now. So if you're employed, primarily if you earn over 75,000 or your household income over 75,000, the majority of the big banks will offer you up to 5.5 times your income. Now, some banks deal with variable income differently, so bonuses, commission, that type of thing. Some banks will include, say, half of that figure, or some banks will take all of it if you've got a good track record. So in the example I sort of laid out, just to keep maths really simple, is if you've got a basic salary of 100,000 and a bonus of 100,000, that first approach of a bank taking your full basic and half of your bonus, that means you'd be able to borrow roughly about £825,000. The second approach, where banks take 100% of that variable income, that would mean a loan of around 1.1 million. So massive difference there, and that's sort of the top end. So I appreciate that some banks aren't quite as generous as that, so sort of bear that in mind. Now, if you're self-employed, all of those things I just mentioned apply. It's sort of the same model that works in the background whether you're employed or self-employed, but the big variant when you're self-employed is what banks consider as income. So some banks will take some or all of the following, which would be things like your basic salary, your net profit, dividends. If you're a partner in LLP, it could be your drawings or your profit share. So there's quite a lot of ways of assessing this. There's also another one which is a particular favourite of ours, which is your profit on ordinary activities before tax. So that applies to limited companies, and it shows the true profitability of a business, whether you've taken the income or not. So a lot more complicated for the self-employed, but take those same rules. The numbers will play out about the same. The only sort of real difference is if you are receiving dividends. So this will primarily be for limited company directors or people who have other income. So what some banks do is actually gross up the income. So that means they actually add back on the tax. So they add in about another sort of 20%. So in that same example of having, say, £100,000 basic salary and £100,000 dividend, you'd get to the same numbers. But if you add in that grossed up dividend, that would mean a loan amount of 1.21 million, I believe. So one of the few instances where if you're self-employed and a limited company director like me, you win. So that's great. Not that you probably pay yourself 100 grand basic, but you know how that works. So that's sort of like if you're looking for a property for you to live into. If it is for a rental property, now this is phenomenally complicated and I'm not even going to try and get into this in video. But what I'm just going to do is explain the basic principle, is that same thing applies, is that the bank will ignore the interest rate you're charged. They'll assume an interest rate which the standard calculation is about 5.5%. The reason it's that level is because the highest rate you're likely to pay during the lifetime of the mortgage based on historical rates. Banks then stress that further by typically 145%, and that will then deem the rental income you need to get a buy-to-let, because the rental income drives the amount of lending on a buy-to-let mortgage. So what I've done, again, just to try and sort of keep it sort of simple, is if you get £1,000 of rental income a month, based on those numbers, what does that support as a loan? So under that standard calculation, that would get you a loan of 150,470 for every £1,000 of rental income a month. There is a more generous stress test if you take a 5-year fixed rate, which is that stress rate comes down to 4.5%, and the stress rate can be as low as 125%. And in that example, then that justifies a loan of 213,333. And in the old school, or where top slicing is involved, now this is a situation where banks will factor in your personal income. So I go back to what I said before about affordability being really favourable to the higher earners. A lot of the rules I just mentioned with buy-to-let sort of go by the wayside because you can evidence you can afford the loan. In that instance, generally, as long as the rent covers the mortgage by 125%, a bank would be willing to offer you a loan. So that means the loan amount on that same £1,000 worth of rental income would get you to a loan of 480,000. So by me spitting out loads of numbers, probably fairly boring and difficult to follow, but it gives you an idea. And as ever, we put these numbers on our website. So if you want to look at this a bit more detail, you can look through the various different elements of our website. We've got broken down examples. We'll specifically put these examples there. But if that puts you in the ballpark of where you want to be or makes certain things possible that maybe wasn't possible last year, and that's really the point to this, is you might have looked at this a year ago and thought, well, I can't get the lending that I need to. You probably can now because it's getting to that sort of top end. So if you'll talk to us guys, see how it applies to you directly, please get in touch. We'd love to help.